Hi everyone, my name's Tashi, and I thought it'd be pretty cool to have a very casual conversation with you about Flex. Think of a Flex 101 video series of the sorts. So it's almost as if we've had a few coffees together and we've gone back and forth about what Flex looks like for you if you're a landlord or if you're a large tenant with surplus space trying to figure it out. So the first question I normally ask is, what's the goal of Flex in your mind? Is it isolated to the one or two floors that you're looking at and considering for Flex? Or is it something a bit bigger and you want it to be integrated into a wider asset strategy because it's more about asset value and safeguarding what that value is for you? Because depending on what your goal is will heavily influence, what type of Flex you put into the building, where it goes, and ultimately the type of partner you may look for if you do it yourself and the deal structures you engage with them, which we'll talk about during these video series. So if we start off with the location and I guess the product mix, when you look at your building, you got to think about, well, if I wanted to integrate into what else is going into the building and you've got a bunch of floors available, whether they're vacant or it's a new development, it's pretty safe to assume a good bet would be to integrate it into the ground floor operation somehow. So if you can figure out how to have an integrated staircase from the ground floor to level one, where level one would be, kind of a space for the Flex, whether you need one floor or two, depending on the size of the NLA of those floors. That way, you have an opportunity for the Flex operator to also deliver some sort of concierge, cafe, lounge service in the ground floor, which is quite popular right now, especially if you're a landlord trying to figure out how to have a seamless experience for your tenant customer or the members of the Flex space. So having it integrated into the ground floor, if that's an option, should always be a consideration. And right now, a lot of operators are excited about that opportunity because they get to show off their, hospitality-centric services that they're really starting to ramp up on this year, last year, and in the years moving forward, as you've probably seen. Now, if that's not an option and you've got a relatively large building, lots of floors, turnover floors, I think are always very interesting because if you've got a floor that's essentially going to be a layover floor for, a low-rise, mid-rise, or mid-rise, high-rise, think about the opportunity you have to create an experience on that floor. So you can kind of capture the traffic of both the mid or high or wherever it is and put something sticky there. I tend to move away from the high-rise floors unless you've got, for example, a balcony that you really want activated, because as a Flex partner, or when you think about Flex, especially if you've got other goals attached to it, you don't really want the opportunity cost of, high rent yields on those floors if you can put it somewhere else. So I think always think about ground floor integration first. Turnover floors are interesting, but then don't feel bad if you have to just plug some vacancies in your building, because a lot of the time and the conversations we have, there's just an opportunity where there's a few floors coming offline, and it's an opportunity to put some Flex in, because you never know, you might have an anchor tenant or there may be tenants in the building that you want to retain, that that their leases are coming up. And by putting some sort of third space or flex space in there, your chances of retaining them go through the roof, or they're asking you to do that. So that's what I would say about location. In terms of product mix, this depends on the goal I was talking about at the start, right? If the goal is isolated to the Flex itself, it's pretty safe to say your product mix is going to look like almost every other premium Flex operator in the market. It's going to be dominated by flexible private offices, and it's more a question on how big they are and where they're situated on the floor plan to influence a lot of flow. So even if you think about an NLA in general, and we'll go with a 2,000 square meter floor plate for now. And the reason why I say 2,000 is most of the time that's the size to get a good return on that Flex business. So you get the economies of scale of around, I'd say you can push it a bit lower these days, but 2,000 is very safe because you got fixed costs like staff members, operating costs, technology. Yeah, you throw in your cleaning costs and all of that kind of stuff in there. That's when you've got enough fat for the business to really thrive. If you've got a 2,000 square meter floor plate and the goal is make as much money as possible, almost as if you were going to rent it out to a traditional operator anyway, floor plan's probably going to look, 60% plus of that is a mixture of private offices. And then again, like I was saying, how big, what's the mix of those offices? Do you have a couple of enterprise ones thrown in, like 30, 40 persons, or is it dominated by 6 to 15 person offices? The enterprise ones, the larger ones, if you are confident you can fill it, whether it be through your leasing partner on the building or the flex operator you work with or yourself, go for it. But always understand that those larger ones, even if you can tend to do like a longer deal, you're going to have to work hard to make sure you refresh that customer or you get someone in there, because no one likes having a 50-person office just sitting there and impacting the cash flow of a flex business, right? So that's always something to consider. And then when I say around that 60%, the remaining 40% generally is broken up into circulation, meeting rooms, breakout spaces, concierge, all that kind of stuff. When the goal changes to be less, let's make as much money as possible out of this floor, and more, let's put in some cool stuff so that our tenants use it and they can encourage their employees to come back, or we want whoever using that space has a bunch of amenities within there to really make it almost like a lifestyle experience-driven space. Well, then the 60-40 split probably looks something more like a 50-50 split or a 40-60 in terms of the NLA you dedicate to those private offices gradually shrink, and you start allocating it to more of those amenities. And some of them you may be able to make money from, but others are probably a free service you provide to the members or the tenants in your building. And that balance is really up to you as an owner, especially if you're a landlord, because you have to think about, do I want more money off this floor? Or is the value infinitely more, which I think it is, of retaining the other 20 floors of tenants within the building and making sure that they're happy and they're paying rent, we don't lose them? How do we safeguard the value of our asset? Is it by squeezing an extra $100 a square meter or two out of the flex floor, which is 2,000, 3,000 square meters? Or is it tweaking it in a way that everything else, you've got your leases full and everyone's happy and you've differentiated that asset? So that's what I have to say about the location and the product mix. A pretty important decision to make, and this goes for both landlords and major tenants looking to do flex within their own tenancy, early on is this going to be a tenant focus, and this is if you're a landlord, a tenant focused operation, or a third party, let's fill it with anyone that has a pulse in some markets, commercial operation? Because that's going to influence how the space is going to be run and potentially who you even speak to from a flex operator perspective to partner with. Because there's brands and operators out there that won't have that discussion with you. And rightfully so, because the commodity-driven co-working model will always exist and always has a place in the world. Think of them more as a tenant. If they're going to pay you rent, don't even think about saying, hey, can you do X, Y, and Z for me? Just be grateful that they're coming to you and they're going to pay rent, and think of them as a tenant. But when you start working with a partner, or you try to do it yourself, understanding who your focus demographic is really going to influence the way you operate the space and even the way you design that space potentially. So for example, if you're focused on tenants, even the way that it is run from an occupancy perspective, or even the way you price certain products, needs to be a heavy consideration very early on. Because there's no point forecasting a very high occupancy, even if you assume very conservative ramp-up periods, if you know for a fact for this to be a success, if an anchor tenant or a VIP tenant in your building wants to use the space, you cannot say no, because half the reason you're building this is for them. And that's often the time why, and we'll get into this later, many business cases or feasibility studies around flex, sites within your assets that you've seen cap out at 80 to 85% occupancy. Two reasons really. One is because at the end of the day, we're in a flex business kind of world, and majority of the deals, even though they're under 12-month licenses, some 6 months or months to months, there's going to be fluctuation in that cash flow, depending on who you can retain or who churns or whatnot. That being said, especially from the more hospitality-driven or premium operators, the average life cycle for a lot of flex customers are increasing. They're eclipsing 2-3 years. So, and I also think that's, going off on a tangent here, I also think that's why flex is being more well received from a cash flow projection perspective, because flex 2 years ago, when people thought about it, they thought co-working, really small companies that were month to month, so cash flow could look like this, whereas it's evolving into a more enterprise-driven, larger company, satellite offices, more mature market that actually want to stay there longer because they may not want to enter into a long-term traditional lease, right? So the cash flow is relatively trustworthy depending on how you run it. The other reason is if you start working with an owner or a partner that wants you to reserve a certain amount of space for key tenants or key customers, that 20% or 15% cap in terms of the cash flow analysis, that's where it comes in handy, because then you're not forecasting money that you may not be able to make because you need to hold some stock on hand. Because you could forecast with some sensitivity analysis, 90, 95%, 100% occupancy. It'd look great. It'd look way more than what you probably would receive from a traditional rent perspective, but that's part of the reason why they do it too. I mean, yes, there's ways to put in clauses where you can hit 100% occupancy, but then say, hey, we reserve the right to whoever uses X, Y, and Z suite or private office within the plan. So you mark them out and you manage expectations. We can essentially kick you out with a month's notice or whatnot because someone else needs to use it. You can, and operators are testing that out, but that can get a bit complicated sometimes. I'm not saying it doesn't work, it's just still being tested. So that's why the safe bet from even a forecasting perspective is just cap it out at 85. And then, yeah, you can do some FISOs that show higher, but base case, look at 80, 85% in terms of an occupancy perspective. So that's really important when you're tenant focused. From a tenant perspective, now shifting over, if you're a major tenant with surplus space and you're looking for a flex partner or you're looking to do flex yourself for other reasons, and we're having lots of conversations today about that, as in my team with major tenants, how much of it do you want your employees to use? Because yes, rent recovery is awesome, but if you're having trouble with return to work and you see a flex kind of offering, a conduit or a Trojan horse almost to put some really cool amenities or have an operator in there to provide a hospitality and a lifestyle driven experience to make everyone happy and come back in, how much of that space do you want to dedicate to that? Because how important is that to you? If your return to work is only 30, 40% right now, and this could kick it up to 60 or 70, that's pretty important. That's pretty cool, right? And then, of course, if you decide against all of that and you want pure commercial, kind of speaking to the product mix comment I was saying earlier, don't worry about it. Just leave the operator to do their job. I guess the only thing that you could probably influence from a partner perspective is, if you don't have the tenant or employee focus, what select industries you'd like to be in the space. Because you might want it to be an incubator. As a landlord, you definitely actually would want it to incubate customers that when they graduate and grow, they turn into long-term tenants. And as a tenant who might want to target certain industries, if you do your flex offering, you may want to get close to a bunch of industries that you want to partner with or essentially put your product in front of. So now, I guess this is a good opportunity to talk about the different types of deals that exist in the world and what that means for you and why you should consider it and what are the benefits and the cons and all that kind of stuff. And this is purely based off my experience and what I think. So, and I mentioned this in the beginning, you've almost got three, I would say, tiers of deal or consideration when it comes to a flex operator. One's traditional, and we all know it. So think of them as a tenant. So they're going to sign a lease, they're going to re-rent your space, they're going to pay your rent, and they're going to make enough margin to keep their own business happy. So when it's traditional, again, as a landlord, just consider them a tenant. If you can tick a box that you have flex in the building, great, but don't expect anything more than that, because I think it gets a bit hairy if you want some important tenants or customers within the building to use it when they need to. Chances are, if that flex space is being run well and it's full, they're going to be turned away all the time, which is not the experience you want, which is also why a lot of owners have gone the direction of the second type of model, which is a partnership-driven management agreement style model. So let's call this in the middle of the spectrum. We've got a spectrum left to right. We've got traditional, and now we've got partnership management agreement. This allows the owner to have a bit more control, varying degrees of control. And it really depends on who you partner with on this, because again, let's remember that a lot of these brands and flex operators, they're evolving from being a tenant, right? For the last 10 years, 20 years, they've behaved as a tenant within a landlord, re-rented space. That's what they do, but they do a lot of great things that can be infused into a building for an owner. So now when you look into the management agreement partnership model, the deal structure will start looking something a bit more risky for the owner, but the risk is deserved if you want to change essentially the way the business is run to a degree to benefit your asset and your own goals as an investor landlord. So what does it look like if you change the floor plan because there's certain products in there that's going to land you the anchor tenant that wants 7 floors upstairs? What does it look like if you tell the operator to not fill it and only cap out at 80 because you want your tenants to be able to use it and never be turned away? What does it look like if you want your own brand on there, right? Powered by said operator, because you're trying to promote loyalty within your portfolio and you realize that in the next 5 years, brands are going to be king and all assets may be brands and very hospitality driven, kind of like a hotel. All of those considerations and wants and needs will influence whether how much risk you have to put in as an owner. So I'll give some examples. So let's say you are looking to work with an operator and they're pushing a management agreement on you, and there's some reasons for that, which I'll get into. But they're offering some flexibility. Now, if you don't want a lot of flexibility, but you just want them to go into your asset, you may want some tenant prioritization. You may want them to change the paint on their fit out and maybe potentially the brand, as in like you might want something for your building, but they'll still want to push to have their brand on it to a degree. Because let's not forget, said operators are running their own business as well. Well, then you might start seeing a deal where it's a management agreement, not a lease, but they will guarantee a certain amount of rent. So it was called a hybrid lease for a while. It's been called base rental guarantee management agreements today. It's called a lot of things. But essentially what it looks like is, okay, instead of paying, let's say, the $1,000 a square meter net face, we'll agree to, and then insert percentage. And you can generally get away with higher percentages depending on where your asset is and how much they want to get in there. And then the remaining dollars, that will be made up by some sort of revenue share, profit share arrangement. So we'll agree to pay, let's call it 60% of the rent, but then any revenue thereafter made from the flex, we'll take a percentage of that revenue, let's call it 5 to 7%, and then profit, we will take a share of that as well to help make the operator whole from a fee perspective, but as an owner, so that you've got the remaining profit so that you can make the rest of your rent and potentially more. So that structure has been pretty popular because it's kind of been the middle ground for a lot of owners and operators, and a lot of deals like that have been done. If the owner wants more control, and this is almost shifting into the third type of deal, which is more, I would call a white label management agreement, where the owner wants full control. They want to do all sorts of cool, crazy things because they see that, again, the value of what the flex can deliver eclipses the dollar per square meter return on those square meters. It's more about how do I actually protect our asset value? Because if it helps us fill everything else, come on. That looks more like, okay, as an owner, this is my business. So I will put the risk in, and much like the second management agreement deal, the owner will put in the capital to do the flex fit out, which will be designed and built and guided by the flex operator. But then it will be more of a no base rental guarantee, but a pure revenue share, profit share style arrangement. So the operator comes in, designs it to your needs, designs the floor plan to your needs, runs it to prioritize or even curate and build the type of community you want, brands it completely yours, may not even exist. There's no powered by blah. It's purely yours. You wouldn't even know that the partner operator you have there actually runs it. That would look more like a revenue share, profit share model. So more risk for the owner, but more upside as well if it's run correctly, albeit it's because you've completely wanted to create your own brand and offering, very much like a hotel model. We're starting to see more of those white label management agreement deals because over the last, I'd say 4 or 5 years, it's been creeping towards in that direction. And whilst there's been a lot of just partnership management agreement deals done, and we've done a lot throughout the globe as well, we're seeing more control is important right now. It's almost like flex was a blue sky thinking thought 4 or 5 years ago from a landlord perspective, like, oh, we'll do this to differentiate our asset. But now it's almost like here's a move that we can make to kind of protect. It's more of a risk assessed move to protect the value of the asset right now. by many owners, but it's an opportunity to do something cool at the same time. So you've got the traditional, you've got the partnership-driven management agreement, and then you've got the white label, right? And we're seeing a lot of those. A very strong example of the reason why owners like the white label option is because they get the promise and the control of having their very own incubator. If a member or a user of their flex, because it's their brand, outgrows the flex without it being picked up and moved into another Flexspace or someone else's building or whatnot, you've got the full transparency. You've got ownership of all of that IP, all of those relationships. You have the opportunity to move them into your own building or another building within your portfolio. And then very similarly, any large tenants within your asset that you want to keep, you've got the ability to put the flex that they need or adapt the flex that you have to keep them in your building. So that level of control is extremely important when you think big picture. Now, when we think about flex, we shouldn't limit ourselves to just thinking about co-working and some of the extended operations, whether it be the ground floor activation, the lounge service, the concierge, the cafe, all of that jazz. Spec Suites is a growing product offering, even separate to flex, which the market is starting to accept very rapidly. And I think from a co-working or a flex package perspective, when you think about your building, it's something that should be seriously considered. Research that you probably heard of and you've read is that, by 2030, 30% of all office will be flexible. When you actually dive into that statistic, that 30% is broken into 25% spec suite and 5% flex co-working. So if there is really going to be that large of a market in demand for spec suites, particularly, what are we going to do about differentiating our spec suite offering or your spec suite offering? We can't just rely on the best fit out necessarily anymore. You really have to look at what's the experience that's going to be within that asset, not just particularly within that spec suite, and how we're going to deliver it. So when you think about flex within your building, I'd like you to think about spec suites as well. Because imagine if you had a flex operator or your own flex brand doing a floor or two of flex, maybe some ground floor integration, but then you also have a floor or two or as many spec suites as you think suits your leasing strategy for that building within that asset also. But you leverage the operator who has got on-site staff, who's got a budget to activate the space that they have, who has all these bells and whistles for experiences for tenants within the building and their members, also delivering that to those spec suite clients. I like to call it spec suites with a service, and I think it's a really great way to differentiate your offering. Also, if you think about the journey of a customer within your building, if we isolate it to one building, if you've got a co-working offering in there, you suddenly are able to target customers that you hope one day would be a large tenant within your building, right? They're a demographic that you normally wouldn't be able to touch because you're doing traditional leases. Now, I think it's a stretch sometimes to think that when they graduate from the flex, you can put them into a floor in the building, right? Under a traditional lease. Even though that's a great story and it happens sometimes, it'd be great to have a middle ground padding of a spec suite offering within your building, because it's much more likely that you get a 5 to 16 person flex member within your flex space, that when they grow, they go into the spec suite, and then when they grow, they take a full floor. And because you've got transparency and ownership over that whole process, ideally, you can help ensure that kind of conveyor belt journey happens and you control what that looks like for your customer and make sure they have a very seamless, great experience. So I think spec suites should be a consideration, absolutely, moving forward, even if you're just considering co-working, because you can de-risk the co-working as well. So if you were thinking of 3 floors, 3,000 square meters in this market, or 4,000 square meters in this market, I would be more inclined to go, hey, what does 2 look like, 2.5 look like of the co-working, because you've got lots of smaller products in there. And then maybe a floor spec suite that we can enhance as an operator already in your asset. And then we work very cohesively and closely with the leasing agents to fill that spec suite as well.